All right, hello. Currently I'm in bed, but I just didn't want to skip another YouTube video. So I wanted to kind of recap about what's happening over here. Imagine you just being in the middle of a bullish trend. What do you do? Again, I want to stress on the idea about trading being something fractal. What that means is we can apply that same model on shorter time frames, and in both cases, we just understand that it's a short-term lived trade and it's not something long-term. So you have to understand that you have to be in and out really quick instead of just letting it ride and being greedy, because this could be costly. I already have some things over here lined up. I want to speak about trades going on and working out, not being in the session, and I want to speak about missing the trade. So I actually missed this trade, and that was the trade that I missed, which I'm going to be talking about. But just imagine the potential on that trade. It could have been just probably retired. But yeah, so to go over, let's say we're on the 5 minute, there's not much clarity, so that's when you got to zoom in. This could be happening to you on the 4 hours, so then you probably need to go back to, for example, the 15 minute or the 1 minute or the 1 hour. So whenever you don't see clarity, it just means one thing. It just means you need to zoom in. I'll speak about kind of the way that the model works. Let's say we have a new low over here, and that new low has went on to create a high. Then you have another low that went on to create a high. So now we've basically found our dealing range. Let's say that low created that high. Everything in the middle is basically internal. So if we want to basically trade, we have to find a supply zone or a demand zone. Higher highs are not supply zones, but if higher highs have inducements that could send price lower, then we could understand that price could go lower to a demand zone because we're bullish. So selling in a bullish market basically only works from that mitigation all the way to a demand zone, and then you look to buy. When that is happening, you basically understand the model and the structure of how price is working, which is why I had this analysis but did not trade this, because the gray box is when the market actually opens and when I am actually interested. Honestly, the market opens at 8 in the morning, but the first hour is complete manipulation, which is why it's showing us bearish structure. And then the second hour is when price actually moves the way I want it to move, which is why I have this gray box loaded up. Again, when we have a retracement going on, we want to find that this retracement that created our zone over here is a retracement that had an inducement in it. It had, well, there's a lot of criteria, but I won't go through all of them right now unless you guys want me to. Just let me know in the comments. This basically validates if the zone over here works, but for reference, we have an inducement over here. So I like this retracement, especially on a lower time frame. It went on to create a high, hasn't been mitigated. And then when it's mitigated over here, and then went on to create a new high, this shows us that the zone is now, the purpose of the zone is not complete. So that being said, I understood where I was before the market opens, and I was like, okay, great. What are sellers and buyers doing? I understand we have a low that has created a high and then sent it lower, which means that low that created the high, this one over here that created this high, has been broken through. So now I'm interested to basically sell to that demand zone, only if I get inducements, which I did get inducements. And then when price did this inducement over here, I marked it, and then I was like, okay, great. When I have this one over here, I'll wait for a retracement. When I saw the retracement into the zone, I took it, and I had my stop loss over here. When I say took it, I didn't mean I actually put money on this. I say put it on my trading view over here, and I was targeting the demand, which basically was very kind of singular motion and went to that demand zone. But if I was to be in that trade, and that's why I do these backtests, and that's why I encourage you guys to do these backtests as well. When I do this, I know that I'm not targeting lower. I'm not becoming greedy. I'm not basically doing this and then I'm like, okay, great, it came to my demand in no time, so let me just extend it. This basically kills you, because this takes you from a winning trade into a losing trade, and then you go into the spiral of revenge trading and making it back and all that kind of stuff. So having a trade which is a buy position from here is basically the trade that we normally wanted to take, which is lower high, sent it to higher high, higher low, went to higher high, no lower lows over here, and then when we have the retracement, we just look to buy and break this high over here, which is why this supply zone doesn't make sense unless you're targeting a demand zone. But when the supply zone hits a demand zone, then this becomes irrelevant because we are in a bullish market. So what happens here is basically this over here is basically telling people, hey, if you guys think this is a supply zone, or maybe this new refined zone is now a supply zone over here, so if you were to do something like this, no problem. We will invite you in. But we will only invite you in to then take you out, because when sellers come, let's enjoy life together. But the reality is we're having a big liquidity pool piling up over here, and we have the liquidity pool of this one piling up over here. So we show rejection and then shooting upwards. Now, here's what you have to always keep in mind. In order for you to enter, I realized that I needed a one leg and then a two leg. So basically, we have the demand zone getting tapped into outside of the session. And then when the session opens, I see a one leg and then a retracement. But that's not enough for me to basically continue higher unless I see two legs, which is one leg and then two leg. Now, could I have entered if I were to draw this and then have the 50% over here? Yes, I did have the tap of the 50%. I just didn't like my stop loss being all the way here. I just felt like it was an expensive trade to take. So I stuck to being stubborn and waiting for that demand zone. I also saw that imbalance over here, which basically told me that, you know, there's potential for price to come back here and target this imbalance, and then we can take the trade higher. So I had everything loaded up and I was waiting for it, and then price came here and I was like, okay, great. I have the one leg, I have the two leg, and now the only thing that I'm waiting for, so I have one leg, I have two leg. The only thing I'm waiting for is the tap into the imbalance. Then I realized that it has tapped into the 50% and price could shoot higher. Now, two things is it broke the second leg. So I know that price coming down, probably not that, serious anymore, because we are just chasing right now. And when this happened over here, I was like, okay, let me just see this retracement. If it comes back here, I'll only target the stop loss again. Sure, it's going to be a risky trade, but it's worth it having all this liquidity pools piling up, because the third leg happened, but it didn't kind of take out this liquidity pool. So I was still kind of interested. It's basically how you can always think outside the box. But if I were to enter at that price over here, which was the 50% retracement, and I were to have my stop loss over here, then I were to have my 1 to 3 structured over here. And then I'm not sure if it were to go to a 1 to 10, but I think it did. Let's see. Oh, well, 9.98, but then it never came back. So if I were to extend it, it would go to the 1 to 10. Regardless, this would have been a nice trade. Again, on a funded account, if you were to risk, I don't know, let's say you risk $2,000 on a 200K funded account, this would have been $20,000 for you. And that's you risking basically 1% to make 10%. If you were to close at any portion over here, so as long as price is creating higher highs and not lower lows in a bullish market where you're buying, you're chilling. So if price retraces, but you understand it's lower high, it's higher low, higher high, higher low, higher high, higher low, higher high, it's fine. Now, if you have the 1% to make 10%, great, that's a stretch. Maybe you were to close at the 5%, maybe you were to close at the 6%, maybe you were to close at the 7%. Well, guess what? That is just one trade that results in $5,000 or $6,000 or $7,000 only on a 100K account. So on a 100K account, this would have been your numbers. And then if you get another account, which is another account or a 200K account, then you just double these numbers. You then go to 10,000, 12,000, and 14,000. Now, once you get this money over here, any one of these three, you can just get another account, and then your account keeps on doubling. Your income just doubles by just adding another account to your arsenal, which is the most crucial thing that you guys have to understand. Now, again, I didn't take this trade, so I can remove it, but I don't like to remove it simply because I like to always remind myself about the opportunities that I've missed and the opportunities that I take or don't take or whatever. Obviously, if trade I don't take, I can always look back at it and remind myself. But this is a good aspect, and that's how you operate on the 1 minute time frame. That being said, I hope you guys enjoyed it, and I just want to always kind of give you value because I understand how the struggle feels, and I know that if you don't know where you are in the market, it's gonna be expensive. So if you guys like these things and you like these videos, just please actually do like the video, and please do let me know in the comments if there's anything you want me to go over or if there's any kind of criteria that you normally get mixed up with. That being said, you guys rock. Go save the world.